Welcome, everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone, and welcome to my big Sunday night show. We're going to cover AMC and XRP, but mostly this episode will focus on our enemies, the predatory short hedge funds and the prime banks and brokers that enable them. My focus has evolved to center on our enemies and the things they fear most, such as black or white swans. There's an obvious reason for this shift. And that's the hard truth that AMC can survive over 100 years. It can survive multiple wars, depressions, and recessions. It can survive a pandemic, along with the writers and actors strikes. It can avoid bankruptcy, return to profitability, post its best third quarter in its 103-year history, completely update and expand its business model, and even create new revenue streams. And even if its new line of candy had the potential to cure cancer, the stock price will remain under the control and manipulation of Wall Street. And this festers due to lack of action by regulators and even elements within AMC that deliver strategies that pound the stock ever lower and give an advantage to our enemies, buying them more time to continue what I believe is the greatest ongoing crime to ever be committed in the U.S. markets. Before we dive in, let's take a look back at last week's action, starting with Bloomberg's evening briefing. As markets staged a monster rally in celebration of a potential U.S. soft landing and coming rate cuts, one corner of the financial system has reason to remain on edge. For participants in the overnight funding markets, a key conduit for bank borrowing and a linchpin for determining interest rates, Wednesday's Fed Reserve meeting contained a more pertinent message from Chair Powell, namely that the central bank's balance sheet reduction would continue as planned. A debate is simmering over whether the Fed is misjudging how far it can shrink its balance sheet, a process known as quantitative tightening, without causing dislocations in places like the repurchase agreement markets. See, they get right to the heart of it, part of the essential plumbing of the financial system. And then another headline from MarketWatch. Dow posts third straight record close. S&P 500 scores longest weekly win streak in 6 years. Major U.S. stock indexes book 7th straight week of gains. Now, I have identified the big catalysts to watch for on XRP. Among them, a conclusion to the legal witch hunt with the SEC, which can happen at any moment following a settlement decision or agreement. A forthcoming ETF or exchange-traded fund for XRP. Mass adoption of the coin by the world's leading banks once all its legal challenges are behind it. And of course, the eventual IPO of Ripple itself. But let's get a second opinion from Raoul Pal from the Crypto Potato. Ripple XRP, opportunity of a lifetime, according to former Goldman Sachs exec Raoul Pal. A former Goldman Sachs executive said on a recent podcast that he's long Ripple. Moreover, he is still holding the XRP tokens he bought when the SEC first sued Ripple Labs. Yeah, me too. From the article, long-term XRP investors have shown remarkable patience and resilience as the SEC lawsuit winds down. After a string of victories against most of the SEC's charges this year, Ripple Labs is still battling the regulator over how much of a financial penalty it should have to pay. Real Vision CEO Raoul Pal told Crypto Law founder and Ripple amicus brief lawyer John Deaton in a recent interview that he bought XRP after the SEC filed a lawsuit against Ripple Labs in December of 2020. Powell called his XRP play an opportunity of a lifetime. Quote, when you see something like that, it's like, okay, now the price has been massively discounted. We know it's a real thing. Half the people have been shut out of the market. This is the opportunity of a lifetime. So that's when I bought it, and I've held it ever since. After predicting the U.S. mortgage crisis of 2008, 2009, Raoul Pal served as the co-head of European hedge fund sales in equities and equity derivatives at Goldman Sachs in London. So, not a dummy, right? Now, before we get to the good stuff, let's devote one slide to real estate from MarketWatch. Here are the headlines. The housing market is starting to pick up now that mortgage rates are falling, Redfin says. Falling mortgage rates have already breathed new life into the U.S. housing market, a new report by Redfin says, and that momentum could pick up as rates continue to inch downward. Home buyers got some good news this week when the average rate on the 30-year fixed-rate mortgage fell below 7% for the first time since August on the back of the U.S. Fed Reserve signaling a pivot to cutting interest rates. And another, when will mortgage rates drop enough to entice homeowners to sell? Experts say this is the magic number. U.S. mortgage rates are falling, but that alone won't be enough to prompt homeowners who have been waiting on the sidelines to sell their homes and bring the housing market out of its funk. Experts say rates will have to fall even further to spark interest in selling. Just how low would mortgage rates need to go? The magic number varies, but it's likely to be 6% and below, according to analyses by housing experts. And another, renters are finally catching a break as rents see the biggest drop in 3 years, Redfin says. While rents are starting to drop, they're still 22.1% higher than they were in November of 2019, Redfin noted. Okay, let's get ready for the bell Monday morning and the week ahead, starting with Wall Street Breakfast. The economic calendar is heavy next week as releases covering housing, manufacturing, and consumer sentiment pour in just ahead of the 3-day weekend for the Christmas holiday. The key release will be the monthly update on core PCE. No doubt in my mind, the Fed Reserve's favored inflation gauge is forecast to show a soft 0.2% month-over-month rise in November to take the year-over-year rate down to 3.4%. Crucially, that mark would also imply a 6-month annualized inflation rate of just over 2%, which is the Fed's stated inflation target. That's important. If the core PCE number comes in close to expectations, the buzz over lower interest rates may continue. At the time of this publication, Fed funds futures trading implied a 95% probability that the Fed's target rate would be lower than the current level after the May FOMC meeting. Okay, so let's dig down into the calendar. Beginning Wednesday, December 20th, 10 a.m. Eastern Time, we'll get a look at existing home sales. Also that night, there's an early screening of Ferrari that I'm going to be going to, so I thought I'd point that out. Thursday, December 21st, 8:30, initial jobless claims and GDP. We'll get revised GDP. Then at 10, U.S. leading economic indicators. Then on Friday, this is a big day, 8:30 a.m., personal income and spending, but most importantly, the entire PCE data group. So the PCE index, the core index, year over year, etc. At 10 a.m. also we'll get new home sales and consumer sentiment final numbers. So what's the movie lineup at AMC for the big holiday weekend? Well, we've got The Iron Claw. Then there's Anyone But You that looks like a romantic comedy, so Jordan should be delighted. Then you've got Migration, Memory, and of course our big draw, Aquaman 2. Trust me, guys, the financial press and the entertainment press are already hammering this flick. It's going to be a flop. We don't have an Avatar for the Christmas holiday. You know, they're going to be laying into it. Then on Christmas Day, we've got the official release of Ferrari. The Boys in the Boat, and The Color Purple. So if I don't go see Ferrari on Wednesday, I'll probably go over the Christmas holiday and try to score an Aquaman popcorn bucket. I don't know. We'll see. As I said, they're already laying into Aquaman 2 from Screen Rant, how much Aquaman and the Lost Kingdom cost to make, and what box office it needs. Aquaman and the Lost Kingdom, the final DCEU movie, faces uncertainty in terms of box office success and its future in the franchise. The movie has a high production budget of $215 million, putting it at risk considering the DCEU's recent box office struggles. The film needs to make over $400 million worldwide to break even, but current projections suggest it may fall short, potentially making it a box office flop. All Uncle Frank and CSI want for Christmas is another hedge fund to take the pipe, followed by a short squeeze, and this headline speaks to that possibility from Reuters. Hedge funds' bearish bets get crushed in post-Fed meeting rally. From the article, global equities long-short hedge funds' bets against U.S. stocks got squeezed in the last 2 days after U.S. bond yields slid. Two investment banks said in notes that were sent to hedge fund clients and obtained by Reuters. Both Goldman Sachs and Jefferies said long-short hedge funds, which take positions betting stocks will rise and fall, got hit hard after Fed Chair Jerome Powell on Wednesday indicated that the U.S. Central Bank's historic tightening of monetary policy was likely over. Ooh, guys, listen to this part. Jefferies trading desk said that long-short hedge funds on Wednesday and Thursday had their second worst two-day move ever as long positions outperformed short bets. The investment bank analyzed a metric called the long-short spread that shows the performance of long versus short trades. Goldman Sachs said systematic equities long-short hedge funds on Thursday had their worst day in roughly 8 years. Negative performance was driven by a squeeze in crowded shorts, momentum sell-off and rally in high beta and high volatility stocks. That's us. Marco Leasini, a managing director at Goldman, said in the note, the investment bank's global markets team said systematic long-short funds based on computer-driven strategy were down 2.8% on Thursday, the worst single day since at least January 2016. I told you guys, you got to leave room for those white swans, those unexpected rallies when they're short. They do a lot of damage to our enemies. Here's hoping they get a couple more. And here's a headline about the prime broker that runs the AMC board of directors from Reuters. Morgan Stanley may pay up to $1 billion to resolve U.S. probe into private stock sales, according to Semaphore. Hey, Semaphore, those are the guys that broke the headline. Our CEO was sending nudes of himself involved in a sex act to a stranger who would later blackmail him. Turns out this was the exact same time he was investing almost $30 million of our money in a previously bankrupt gold mine. How's that investment working out now that gold has posted an all-time record? Ask the Adam Aaron fanboys on Twitter if they ever read the disclosures for that investment. If they did, they would discover the 5 note holders at the time were or currently are short sellers of AMC. There's the HYMC chart on the right. Yup, that looks like Adam thought this out. How'd that reverse split work out for Hycroft? About as good as it worked out for us. You see, the big difference here is HYMC had to perform a reverse. We didn't need to, but Wall Street sure needed us to. Come on, guys, say it with me. There's gold in them thar hills, right? But I digress. Morgan Stanley may pay up between $500 million and $1 billion to resolve a long-running U.S. probe into how it handled private stock sales, Semaphore reported on Tuesday, citing people familiar with the matter. The bank may also agree to tighten internal controls as part of a potential settlement with the DOJ and the U.S. SEC, according to the report. It, however, will not likely plead guilty to a crime, Semaphore reported, adding that no individuals were expected to be criminally charged. Of course not. We admit to no wrongdoing. We pay a big fine. Okay, nobody gets fired, no one loses their license. Resume cheating and stealing immediately. And here's some headlines on Citi, a short seller of AMC, our chief investment banker at AMC, the author of The Ape, its conversion, and the reverse split. We chose these guys to handle our secondary transactions, even though they have a sell recommendation on our stock and a price target under $5, or let's just call it 50 cents on a pre-split basis. Well, we saw how it went for Credit Suisse. Maybe that's what we can hope will happen to Citi. I mean, I ask you, is this a prime bank or a garage sale? Citigroup, massive restructuring to cost $1 billion. Won't be completed until next quarter. Citigroup offers partial early bonuses to encourage employee exits. Citigroup employees on edge over layoffs told they could work remotely until the new year. Yeah, stay at home. Don't worry. You got a job waiting for you. Citibank has started mass layoffs. Citigroup to sell China consumer wealth business to HSBC. Citigroup closes sale of Indonesia consumer banking to UOB. Citigroup to close about 100 branches, cites declining foot traffic. And recently, and I'm sure you've heard by now, Citigroup closes municipal underwriting and market-making unit, memo shows. The bank has decided to close its municipal underwriting and market-making activities, according to a memo seen by Reuters. The economics of these activities are no longer viable given our commitment to increase the firm's overall returns, said the memo, signed by Citigroup's head of markets, Andy Morton, and Peter Babbage, interim head of banking. The memo added that the bank will unwind the unit in the first quarter and that most people working there will leave. Discussions about the future of the unit led to a team of bankers leaving for Jefferies last month. Bloomberg reported on the memo earlier on Thursday. Citi's municipal offering business has been under scrutiny from the Texas Attorney General, who in January halted the bank's ability to underwrite most municipal bond offerings in Texas, saying the bank had discriminated against the firearms sector. Guys, if this shit keeps up, we might ruin all the Christmas parties in the Hamptons. Big hedge funds are trimming staff as the year-end approaches. It's not just banks that let go of surplus staff before the end of the year. Some of the biggest multi-strategy hedge funds seem to be doing the same thing. Bloomberg reported yesterday that Citadel cut 3 portfolio managers in London and 1 in New York, and we understand that there have been various exits at Millennium too, also a short seller of AMC. Both funds declined to comment for this article. Yeah, Uncle Frank hopes all these people getting canned for Christmas head right to the SEC and join the whistleblower program or head right to prison to get their asses cracked open on New Year's. Now, I covered this in a previous video, but ironically, the Motley Fool got this one right. Billionaire Ken Griffin's Citadel returned a whopping $7 billion to investors. Last year, billionaire Ken Griffin's Citadel hedge fund returned around $7 billion in profits to its investors. It now looks as if history will repeat itself. An unnamed insider recently revealed to Reuters that Citadel plans to return another $7 billion or so to investors after generating double-digit gains in 2023. More redemptions, good for us. And do you guys remember what happened to Canadian hedge fund Trainer Ridge? Well, let this be a lesson to all you hedgies out there. This is what your future holds. From Reuters, Canada's ATB Capital to sell off assets of defunct hedge fund Trainer Ridge. From December 16th, ATB Capital Markets, the 8th largest Canadian financial institution, has been retained to liquidate the assets of collapsed Toronto hedge fund Trainer Ridge Capital, a court-appointed receiver said in documents filed on Friday. The mandate is subject to court approval, according to documents filed by receiver Ernst & Young in an Ontario court. In early November, an Ontario court placed Trainer Ridge and the funds it manages in receivership after the sudden death of its sole director, as the provincial securities regulator probes millions of dollars of trading losses incurred by brokers. And the party train keeps chugging along for the hedgies, baby, from Reuters. Hedge funds fall victim to success in dash for cash. The best performing hedge funds are falling victim to their own success as institutional investors, such as pension funds and university endowments, cut back their most profitable positions to make up for pain elsewhere. Investors yanked $38 billion from top-performing hedge funds in the 12 months to end October, having pulled out $14 billion in the year earlier period, data from hedge fund specialist Aurum Research shows. These hedge funds returned on average more than 19% and 18% respectively in the two 12-month periods, Aurum Research said. Wow, it looks like you guys are getting punished for near 20% returns. Good. Now I hope you choke on a wiener in prison. You almost feel sorry for these clowns, right? Andorran's hedge fund set for worst loss on oil bets. Discretionary enhanced fund set for worst year on oil bets. The fund had produced stellar returns in the last 3 years. Oil trader Pierre Andorran's eponymous hedge fund is headed for its worst loss on record, ending a 3-year winning streak as bets on the commodity's prices turn from bad to worse. His main hedge fund slumped 54% this year through December 8th, a person with knowledge of the matter said, asking not to be identified because the information is private. The loss, if sustained, would mark the 46-year-old's biggest since he started the hedge fund a decade ago after closing his previous business. Yeah, on to your next business, pal. You're done. And let's not leave China, Credit Suisse, or UBS out of our analysis. From the Bloomberg Close newsletter on Friday, a hedge fund probe sounds an alarm for China risk managers. A suspected investment scam in China raises diligence questions. Credit Suisse disbands its China onshore wealth unit, and two bond titans clash over the outlook for treasuries. An alleged fraud in China that ensnared financial firms has shaken faith in the safety of client assets. The matter concerns the investment of about 1 billion yuan, or 130 million US, in products that were issued by Chinasoft New Momentum Asset Management, but managed by other hedge funds. Credit Suisse dismissed its entire wealth team in China, including at least 20 relationship managers and investment consultants. Oh, you guys do know this brings Uncle Frank joy. I can't wipe the smile off my face because these people are finally getting what they deserve, and it's only just begun. From Short Squeeze, how the Grinch stole your bonus. I want my money back. UBS is definitely not feeling the holiday cheer. They're coming for the hundreds of millions of dollars in cash bonuses that Credit Suisse paid out. Credit Suisse had a rough end to its 167-year history when it was acquired by arch-rival UBS in March. But in the years leading up to the collapse, Credit Suisse was rocked by scandal and hemorrhaged money every quarter. So to prevent deal makers from leaving, they threw around $1.4 billion in bonuses to retain talent. But they came up with a stipulation. You couldn't leave the firm within 3 years. Now UBS is demanding those who left the firm and received those bonuses return the funds, threatening legal action. UBS aims to recoup approximately $750 million from those bonuses. Takeaway? UBS pulled off the biggest bank merger since the global financial crisis, and they're looking to slash $10 billion of costs and will axe 3,000 jobs in Switzerland alone. But don't expect the former Credit Suisse bankers to hand back their bonuses that easily. Both sides will definitely lawyer up and probably meet somewhere in the middle. What the Adam Aaron ass lickers on Twitter like Sojka, Crystal Ball, Stephanie don't understand is what Credit Suisse was doing. Taking huge bonuses that may be clawed back now is exactly what the senior executives of AMC were doing in 2020 when the theaters were closed down, when we were being starved for releases. They were pumping up their bonuses because they thought the company was going down. Remember this meme? In 2020, AMC lost $4.6 billion, but Adam's comp plan doubled to $20.9 million. Can you guys see it now or not? And now from Shit Ranks. Bank of America turns down as credit card troubles grow. This was a development that was sadly only too likely to happen. Bank stock Bank of America, a short seller of AMC and Kenny Griffin's personal subprime lender, offered up some numbers on charge-offs and delinquencies for credit card users, and the numbers weren't exactly encouraging. In fact, they're on the rise, and that in turn sent Bank of America shares on the decline, down over 1.5% in Friday afternoon's trading. Some recent headlines for you. Wells Fargo shutters 12 branches, while Bank of America closes 5. Bank of America pays $12 million fine for misreporting mortgage data. And then, previously in Bloomberg, Citadel Securities launched a $400 million loan on Monday, with proceeds to be used for general corporate purposes, including trading capital, Bloomberg reported. The new debt, which holds the lowest rung of investment-grade ratings, will be added to the company's existing $3.54 billion term loan. Okay, so Kenny went begging, and Bank of America is going to advance him another $400 million, but it is the lowest rung of investment grade, right? That's how great Citadel is doing. Bank of America is leading the transaction, and institutional investors must decide if they will participate by this past Wednesday. The point I'm trying to make here, guys, the primes are getting hit on all fronts. Here's another. Underwater car loans signal U.S. consumers slammed by high rates. Negative equity on automobiles is at the highest level in more than 3 years, with higher prices and borrowing costs hitting owners. But it's also going to hit the banks. Back to AMC with some headlines from today. Variety, Timothée Chalamet's Wonka tops box office with $39 million debut. And from Deadline, Wonka sweetens pot to $150 million plus global amid expanded rollout. Songbirds and Snakes sings past $300 million worldwide at the international box office. I know some of you don't like that I cover this aspect of the play, but I'll take whatever I can get to ring the cash register for the fourth quarter. From Screen Rant, Godzilla Minus One passes huge box office milestone as kaiju moviegoers outgrosses many Hollywood blockbusters. Godzilla Minus One has added another $5 million at the domestic box office. This means that its cumulative total has now passed the $30 million milestone. The movie has outperformed over a dozen 2023 Hollywood blockbusters at the domestic box office. I think it's important. Speaking of the box office, who remembers the original bet on this turd hunt? They said we would fall into bankruptcy. Well, we didn't, and we didn't get paid. Then they changed the bet to we will never be profitable again. Well, we did, and we didn't get paid. Now the bet has changed again, and they're saying we'll never do as well or better than pre-pandemic or 2019. I disagree, primarily because of our new distribution business. AMC is the only theater chain positioned to do better than 2019, in my opinion. In fact, we just had the best third quarter in the company's history, and that included 2019. The fact is, we are capturing far more per film now than we were in 2019 and on far less number of releases. So if Hollywood continues to recover and gives us more films, if we keep getting business from the streamers and our new distribution business, I think we're close to smoking the numbers we put up in 2019, which was what? 11.3. You could see on the left side of your screen. 2020, year of the pandemic, 2.1 billion. 2021, almost 4.5 billion. 2022, 7.3 billion. And 2023 so far, with a couple weeks to go, 8.4 billion. But look at the number of releases, only 542. You'd have to go back to 2019 to find a year, where we did over 500 releases. You've got to let this business catch up with itself. I've got to be honest with you guys. I don't know what's going on with this swap. I put it on the calendar. It was supposed to expire on Friday, a near $1 trillion swap. Now I don't know if it exceeds a quadrillion or even a quintillion. It appears the expiration has been pushed out to January 8th now. I will continue to monitor this land whale to see if it hits shore. Now, when it comes to Q4 and how we're going to finish out the year, this article from tonight says it all and even does the math for us. From Variety, with 8 movies left to debut in December, where will the 2023 box office end up? Will we hit $9 billion? Analysts have predicted, or at least hope, that's where domestic grosses would wind up. And there are no less than 8 new releases set to unspool over the next 14 days, which could help theaters finish the year having passed that coveted figure. As of December 17th, the domestic box office has collected $8.58 billion according to ComScore. That's roughly $416 million away from $9 billion. Wherever ticket sales end up, it's already the highest grossing year since COVID upended the movie theater industry, far above 2022's $7.46 billion haul and 2021's $4.56 billion tally. But it's not quite at pre-pandemic levels when the box office comfortably reached 10 to 11 billion a year. Part of the fall off is because Hollywood studios have been putting fewer films in theaters. The next 2 weeks will bring several high-profile releases, including Migration, Anyone But You, The Color Purple, Aquaman, and The Lost Kingdom, and A24's The Iron Claw. There's also Neon Racing's drama Ferrari, director George Clooney's The Boys in the Boat, and the literary satire American Fiction that will make their way to the big screen before the clock strikes midnight on New Year's Eve. Quote, "The pressure is on for these films to deliver big to get us to $9 billion for the domestic full year," says a senior ComScore analyst. In recent years, a single blockbuster, Avatar: The Way of Water in 2022 and Spider-Man: No Way Home, completely dominated the Christmas box office. But this time around, the analyst adds, the wealth will be spread across several films. But the trouble is, the theaters owners don't expect to host a $1 billion grossing behemoth to cap off the year. And even if the movies on schedule are successful at the box office, they aren't expected to collectively live up to the coinage generated by the last 2 holiday seasons. Theater owners believe the day of the week of a holiday can work for or against moviegoing. This year, they aren't too excited that Christmas Day lands on a Monday and New Year's Eve falls on a Sunday. It's better for attendance and popcorn sales if they take place on a Thursday or Friday. Quote, "In some years, getting another $417 million on the books in the home stretch of the year would be a cakewalk." And the analyst said, but this year it's more of a crapshoot with some unique variables in place. So I guess it's up to the 3 million plus apes to flood the theaters and ensure that we hit our $9 billion number. Listen, guys, I can't just report the good news. I'm obligated to you to also report on the bad. I hope you're still with me, because if you listen to this slide carefully, you'll instantly be smarter and more informed than all the rah-rah Adam Aaron supporting idiots on Twitter combined. I think what's happening next is the hedgies and primes will continue to do their best to tiptoe through the landmines and duck the swans until they get to next quarter. Then they will rev up the hit piece machine, and this is what they will be pushing as a narrative, in my opinion. Headline from The Hollywood Reporter: see you in 2025. Box office may take $2 billion hit next year amid delays. From the article: don't be surprised if top Hollywood studio executives and theater owners aren't feeling the Christmas spirit this year. They're bracing for a tumultuous 2024 ride at the domestic box office after a slew of high-profile tentpoles, in other words, big-budget movies, were pushed to 2025 because of the lengthy writers' and actors' strikes. In a major blow to the post-pandemic recovery effort, domestic box office revenue in 2024 is now expected to come in behind that of 2023, a reversal of fortunes no one predicted. If projections are right, domestic box office in 2024 could top out at 7.5 to 8 billion compared to an expected 8.8 to 8.9 billion this year, say multiple studio executives who spoke with The Hollywood Reporter. A few are more bullish in thinking 8 to 8.5 billion is still possible. The culprit? A sparse release calendar, particularly during the first 3 months of the year. Quote, "It's a disaster," says one studio exec regarding the first part of the year. All told, the global box office could lose out on $2 billion or more because of the 2024 movies that were bumped to 2025, including the next Mission Impossible, the next Captain America, the next Snow White, the next Spider-Verse film. Other movies that fled for 2025 when the strikes commenced include Blade, Elio, Thunderbolts, and Dirty Dancing. Quote, "The reality is that the box office isn't the same as it was before. There have been two seismic shocks in the past few years. First the pandemic, and now the strikes. At the same time, streaming exploded," says who? Analyst Rich Greenfield of Lightshed Ventures. Now, guys, that is not an analyst. That is a predatory short seller. He is long streaming, always has been. He's the idiot that put a 1 penny price target on AMC and lost all his credibility. Okay, so double chin Richie Greenfield, I don't care what he says. He is completely against theaters and he never acknowledges any of the milestones that AMC has achieved over the past couple of years. So this guy is not a friend to our business. Goes on, at this juncture, no one is sure when or if the North American box office will return to pre-pandemic levels or 11 billion annually. Okay, now that's the stick that we have to jump over, right? Nor is 2023 revenue likely to cross 9 billion as originally expected after a dismal November, further complicating matters. Consumer interest in moviegoing has been permanently altered and audiences are much more selective, says Greenfield. I disagree. I think people have proven that they actually value the theater experience. In recent days, the National Research Group has been presenting its takeaways from 2023 and forecasts for 2024 to clients, which include all the top Hollywood studios. A major point of emphasis was the lack of event product next year because of the strikes, according to a studio executive who participated in one of the briefings. One startling statistic is the year-over-year dip in the number of wide releases, films that play on 2,000 or more screens. As of December 13th, there were approximately 82 such wide releases on the calendar compared to an estimated 97 to 99 in 2023 per a tally from Box Office Mojo's database. The number should already be exceeding 2023 levels, not going down as the box office recovers from the pandemic era. There were 120 wide releases in 2019, another stick for us to jump over. Quote, "The calendar for next year is in rough shape and studios need to be clear-eyed," says NRG head of film Ray Subers. The downturn couldn't come at a worse time, considering that moviegoers are showing signs of life in terms of returning to the cinema in mass numbers. Look no further than the cultural phenomenon known as Barbenheimer. Thanks in large measure to Greta Gerwig's Barbie and Christopher Nolan's Oppenheimer, 2023 summer revenue all but matched pre-pandemic levels. And even while 2023 domestic box office revenue won't hit $9 billion, it will still be up a promising 19% over that of 2022. Listen, guys, I will admit we face a serious problem in Q1 of next year, but nothing about the number of releases can change the hole the hedgies have dug themselves into. Redemptions are up. Everyone and their mother is complaining about their leverage levels, which can be as high as 60 to 1. They are potentially facing billions of synthetic shares still unreconciled. They are borrowing money at elevated rates and at subprime grades. I can say honestly and without hesitation, not investment advice or advisor, AMC will survive 2024 and many of the hedgies will not. But in my opinion, we desperately need some new concerts, okay, to build on our new distribution business, a suspension of these ridiculous stock bonuses paid to senior management. We need an investor relations department that can actually broadcast all of our achievements, and we need to fire Citi as our investment banker and replace our CEO with one that is shareholder value focused. It's that simple. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.